Hey everyone, this is Vishal from Uncharted FX, and I'm gonna do something a bit different for the next few weeks. I'm making a video series here on YouTube titled Forex for Beginners, and what we're gonna do is we're gonna look at aspects of trading that will help people who are brand new into trading. We're going to specifically talk about Forex, so we're going to be looking at Forex charts. However, the principles and concepts that you will learn can also be applied for other markets, so cryptocurrencies, for stocks, for commodities, whatever you want. But again, we're probably going to be focused more on currencies when we are looking at charts. So the very first thing is, how do we read a currency quote? If you go to your banks or if you go to foreign exchange, you're probably already familiar with how to read quotes. So essentially, we have our base currency here, which is the euro. So the euro against the US dollar, which is the quote currency. So what this is telling us is 1 euro, because it's the base currency on the left, 1 euro is equal to 1.11212 US dollars. So again, base currency and the quote currency, and you can see here we have multiple crosses. So these are called cross pairs, of course, right? Because you're the euro against the yen, etc. Well, technically crosses are the other pairs. The majors are called, anything with the US dollar is called a major. So Aussie US dollar CAD, New Zealand dollar US dollar, US yen, pound US dollar, US Swissy, euro US dollar. Those are pretty much the major pairs that generally everyone trades, and a lot of brokerages have very good spreads offered for those major pairs. And everything else is generally called cross pairs, right? So you see I have pairs here that are not US dollar pairs, so it's everything else compared to each other, right? So in this case, the euro Aussie, how would we read this? So again, remember the base currency versus the quote currency. So when we're looking at the chart, when price is going down, the Aussie dollar is appreciating or strengthening. When price is going up, as in this case here, the euro is going up while the Aussie dollar is depreciating. So again, when price goes up, we generally call that appreciating. So strength is called, the currency is appreciating. When price goes down, we call it depreciating. So in this case, again, when price is going up, the euro or the base pair is appreciating, while the Aussie, in this case, because that is our quote currency, is depreciating. But when price goes down, the Aussie is appreciating while the euro is depreciating. So that's how you read any of these cross pairs. Simple, appreciating, depreciating. But again, it really depends on the base currency here. When it's going up, it means the base currency is getting stronger. When it's going down, it means the base currency is weakening against the other currency, which entails that this currency, the quote currency, is getting stronger. So we're going to be looking at the euro US dollar when we talk about candles, which is the topic of this video lesson. And I just want to talk about euro US dollar because it is pretty much the most popular Forex trading pair. So how do we read candles, and what are candles? Candlesticks is a type of charting which shows us price action, which is the movement of price in an asset or in a chart, in this case the euro US dollar. So if you're familiar with TradingView, again, we have different types of charts. We have bar charts, which show us different things. We have a line chart. But we're going to be talking about candles, which is, generally very popular. It was brought over from Japan by a guy named Steve Neeson. So if you search up candlestick charting or candlestick charting books, generally his books pop up. His book, I believe it's called Japanese Candlesticks, A Contemporary Guide, is considered like the Bible of candlestick charting. So he's the guy who brought it over. So if you want to learn more concepts or learn interesting history about the guy who made it, it was a Japanese rice farmer, then that's a good book to definitely consider looking at or even taking out from the library. So let's just look at specific candles here. And again, what candles show us is they show us price action of an asset for that time frame. So you can see here I'm on the 1 hour chart, which means each of these candles represent 1 hour of price action. If I go to a 1 minute chart, each of these candles represent 1 minute worth of price action. And you can see here, this is the active candle right now. It just closed. So now we have a new candle that's about to take place. Let's see if it's going to move a bit. There we go. So now you can see this is the active candle. One important thing that I recommend is do not make mid-candle decisions. And what I mean by that is wait for a candle to close. So you'd be acting on this candle. You do not want to act on this candle, and you'll see why when we actually look at how to read these candles. So let's do that right now. Let's find a red and a green candle here that are side by side. So let's look at these ones here. And again, you know, green is generally associated with price going up, red is associated with price going down. You can choose whatever colors you want, all right, for your candles, but you always see green and red because, again, green is associated with up or price going up, and red with price going down. So to read candles, we have two things we want to look at. The first thing is called the wicks, which are these little skinny lines, and that is, you know, candle wicks, right? So that's sort of where candles got the term candlesticks, because these wicks make it appear like a candle. Some people call them shadows, which is, you know, okay, a lot of textbooks call them shadows, but I like the term wicks just because you know, it sort of looks like a candle wick, so I'd rather use that line. And this area here, which is green and in this case red, this is called the body of a candle. So the body and the wicks. So let's look at the wicks quickly. The wicks will never change. What I mean by that is, like, the top here will always be the extreme highs and the bottom will always be the extreme lows. So again, for wicks, extreme highs, extreme lows, extreme high, extreme low, extreme high, extreme low. So that tells us in that 1 minute worth of price action, this is where the extreme high was, that was where the extreme low was. But the body is what is a bit more significant. And again, what the body shows us is it shows us where price opens and where price closes. So for a green candle, here is our price open and here is our price close. So think of green, the close has to be higher than the open. And that makes sense because, you know, if you're buying, you want price to close higher, so you're positive. That's why the candle is green. So again, price open, price close. If the close is higher than the open, you have a green candle. And then we can just flip that and look at red candles. If price close is below the open, we have a red candle. So how would we read this? Because this candle is green, price opens, we shot down, hit an extreme low, price was then bought up, we hit an extreme high, and then price closed here. And we know that because, remember, the close has to be higher than the open, because it's a green candle, right? So that's how we can sort of look at the trajectory of price, follow price. In this case, the opposite. So we know it's a red candle, so the price close has to be below the open. So we have our open here, price shot up, it looked like it was about to continue higher, and then the seller stepped in, brought price all the way down. We hit an extreme low here, and then price closed here. So very simple. Green candle, the close is higher than the open. Red candle, the close is below or lower than the open. And now you can read any candlesticks really, and you can see candles like this. Sometimes the low and the open will be the exact same, and sometimes the open and the low, the open, close, and the highs and the lows will be the exact same. So in this case here, price opens here, that's the extreme highs, price closes here, and that's the extreme lows as well. So sometimes you'll have no wicks. And sometimes you'll get candles like this where there is no body. So what this is showing us there's a battle between the buyers and the sellers. So there's some indecision. So price opens here, shoots down, then shoots up, and then is brought back down and closes here. And then vice versa, you could say price opens here, shoots up, is brought down, and then price closes here as well. So there's just indecision, a big battle between the bulls and the bears. This candle here, if you're interested, is called the doji candle. But now you have proper tools just to read regular candles, and you can sort of apply psychology, right? Look at it through the lens of warfare. Okay, look, price opened here, went up, the buyers tried to bring it up, however the sellers stepped in, brought it down, and price closed here. But then look at this next candle, price opened, hit a low, boom, shot back up, price high, and closes. So just by reading candles, I think individually will be very helpful. Here's a very important candle, and this is why wicks are important, and also why we don't make mid-candle decisions. We wait for candles to close. So when you're reading this candle, price opened here, shot down. So if this candle, while it's open or mid-candle, it'll be red. It looks like there's a big sell-off. You're thinking, hey, I'm going to miss this move. I want to jump in. But then look what happens. Price reverses, hits this high, and then closes here, and you're left holding a losing position. So this is why we wait for candles to close. This is a very important candle. This is called a hammer candle, and essentially what this shows us is that there's a group of buyers below here, and you can tell that because there's a large wick. So there's a group of buyers are somewhere below here, and the way to define a hammer candle is essentially the wick has to be very long, and specifically it has to be twice the length of the body here. So I mean, in this case, it's like 4 or 5 times the length of the body here, even more maybe. So that's what defines a hammer. I guess you could define this as a hammer too, because it looks like maybe we're not double the size, but something like that. And this leads us to something very important. We look at candles in context. So not every candle will matter to us, but candles at specific areas or specific zones will matter to us. And these zones, are going to be covered in future lessons, future video lessons. But I think there's one more candle I want to talk about, and that is called the engulfing candle. And I think just by the name, you can pretty much understand what I'm going to talk about. Engulfing candle is these large green or red candles, but specifically they engulf the body of the previous candle. So in this case, this body engulfs the previous candle. Here we have an engulfing. It engulfs not just this candle, but also 1, 2, 3, 4, 5. So just by reading the candle tells you a lot. Price is doing nothing, and then all of a sudden you get this big surge of buyers who push price up, or in terms of a red engulfing. So here's a red one. Right here, this red candle engulfs this previous green one. You can also have one here as well, but just by reading this, it shows us as a big uptrend, and then there's a big group of sellers now stepping in. So again, this is where context is very important, specifically for engulfing candles. And for engulfing candles, we want them to appear at very highs or at very lows, so in a downtrend or in an uptrend. And that's where these candles provide us more signals. And how are we going to find out where these uptrends and downtrends are going to terminate or are likely to terminate? Well, in the next video lesson, we're going to speak about support and resistance, and what that's going to do is that's going to give us a bit more structure to the markets. So I think just reading candles are important just by looking, just to be able to read charts. But I think not only is charting and reading candles important for your financial matters, for trading and all that kind of stuff, but I think nowadays in this world of fake news, a lot of these charts tell us the real news. It tells us what's actually going on, and I think that's important, specifically when you look at, say, the bond market. Here's the 10-year yield and the 2-year yield. You can even think about the stock market, but there's some other things happening in the stock market that if you follow my work on my blog or my YouTube videos, I believe the central banks have sort of manipulated stock markets in a certain way, but debt markets are still very important. And if you want to understand what's going on in the world, just by looking at the debt market, you can sort of realize, hey, wait a minute, this is happening. Or if you look at oil and gold, that will tell you something as well, right? And maybe even tell you about certain geopolitical ambitions of countries, like, hey, why are the Saudis doing this? Oh, oil is doing this. Of course, there's a lot more, but I'm just saying, in this world of fake news, a lot of charts will tell us the real news. So that's it from me. And in the next lesson, we're going to be looking at, well, this is perfect how this showed up, but we'll be looking at support and resistance. And what this does is it gives us a way to structure our market and provide structure for them, and also gives us areas that we will watch for candles. And again, these are spots where the context is what matters, and when we see candles at these specific areas, again, in their context is what matters to us. So again, I'll see you guys in the next video.